The global financial system is the worldwide network of institutions, markets, and rules that manage how money moves across borders. It helps countries to access capital, invest, manage debt, and drive economic growth.
But while the system supports global trade and development, it also leaves many countries behind, especially those in the global south. Africa in particular faces some of the highest borrowing costs in the world, carries rising debt burdens, and has limited say in the institutions that control this system.
Well, originally meant to support recovery and growth, these institutions have, in many cases, enforced austerity, cutbacks, and policy conditions that deepened inequality and economic dependence. And despite calls for reform, very little has changed.
So does this system still serve Africa, or is it time to look somewhere else? If not, what are the alternatives?
This week on the program, we will unpack the origins of the global financial system, ask why borrowing remains so expensive for African countries, and explore whether true reform is even possible. I'm Beatrice Marshall from CGTN.
I'm Hibak Said from TV47. Welcome to this special episode of Talk Africa, co-produced with TV47. We have a lot to unpack, so let's bring in our panel of experts. Joining me here in Nairobi is James Shiuati, the founder of the Inter-Region Economic Network. Also with us in studio, David Owino, the Advisor Africa Development Think Tank.
And joining us via Zoom from Abuja in Nigeria, Sarah Maka, Africa Executive Director for the One Campaign. We also have an audience of experts from the Africa Development Think Tank and students from the University of Nairobi participating in our discussions today. Thank you all very much for being a part of this discussion. James, let me start off with you here, because the global financial system as it exists today was designed in an era that did not put into a factor in the realities of the global south. Institutions like the IMF and the World Bank were created when most African nations were not even independent. And those African nations are still adhering to that system today. So how has the origin shaped the biases of these global institutions like the World Bank and the IMF?
First of all, the time these institutions were formed, what are popularly referred to as the Bretton Woods institutions, they were formed when the West was largely colonizing and seeking to colonize Africa. So in their mindset and in their thinking and infrastructure, their approach to Africa is about extraction. So if there's any financing happening to Africa, it's financing to get cash crops, back to European markets, or financing to get raw materials to power industries in the Western markets. And that explains why Africa, with its vast wealth in mineral resources, its vast wealth in agricultural land, still imports food close to 110 billion per year. It imports virtually all the machinery from the industrialized countries. So it's a financing system that does not really favor growth within the continent. And that's why you notice in terms of Africa's trade participation globally, we are still at 3%. Imagine 1.4 billion people only trading at 3% in the global trading system. So it's in the mindset of those institutions, unfortunately, not really to turn around the situation in Africa. And that's why African leaders, African intellectuals have been pushing for a review of these systems or seeking alternatives to the same.
And let me come to you, Sarah, from Abuja. Africa faces some of the highest borrowing costs in the world, and this is often blamed on what they call the Africa risk factor or risk premium. How exactly is this driving up the interest rates, and why is Africa considered inherently risky?
So right now, as we speak, nearly 60% of developing economies are assessed by credit rating agencies as high risk. So as of 2023, this is 60% of us. And in developing countries, they spent about $1.4 trillion to service their debt. And the African debt service totaled about 102 billion in 2024. So this risk premium is not just a metric to determine whether you can pay back your debt. It actually hampers our development trajectory. Now, why does this risk premium exist? There are a constellation of reasons. Number one, it's a mix of the perception of Africa, the structural bias to what James mentioned around how these institutions were created, the market dynamics, and quite frankly, Africa also holds some culpability to this. And by that, I mean many credit rating agencies in the three oligopoly credit rating agencies. So it's Fitch, it's Moody's, and it's S&P. They're the only three in the world that can rate a country. So already we have a problem. They're based in the US. Their geographies, they're not based on the continent. Even if they have outposts, the methodology to count what is risky is often imprecise. Sometimes they don't take advantage of some of the things we do on the continent, like partial risk guarantees or some kind of insurance to make sure our borrowing is not so risky. Those things don't come into calculation. So the methodology is a little skewed to perceive Africa as risky. Secondly, on the Africa side, we don't have as much data so that when these credit rating agencies come to our countries, we can demonstrate the strength of our economies. Also, a lot of savings in Africa are being saved outside of the continent. So even for us internally, our central bank reserves are not being invested necessarily in the continent. So it really speaks our ability to demonstrate our strength. So we have some things to do, but also the credit rating agencies and the global financial architecture must also incorporate Africa's strengths in the methodology.
So David, I want to bring you in on that whole question that Sarah's talking about, a structural bias here, because we do see some double standards in the way the IMF bailout packages are given out. Argentina, for instance, has defaulted 3 times and yet still receives an IMF bailout. African countries on their side are struggling with debt issues. Why is that?
Without repeating any that have been mentioned by the panelists, one glaring thing that you have to realize is already there is an inherent inequality that is happening with regards to representation of African voices within these broad fora. And that mis or unbalanced representation or lack of representation leads to Africa being essentially left out of many of these conversations. And so, that has happened. If you look at, by way of example, on the issue of debt, the SDRs, which are really you could look at them as shareholdings of countries within the Bretton Woods institutions. Africa's representation there is very, very low. And when it came to actual debt servicing, debt relief, if you look at the COVID crisis, which is a good example, there were over $600 million worth of SDRs created at that point to deal with the COVID crisis. And what Africa ended up having is just about 7%. If you think about Africa's population being over 17% of the world, that's quite unequal. And so it's really a structural problem, with lack of adequate representation of African voices within those leadership circles.
Let me throw this back to James. Now, let's talk about the IMF programs. A report by the Center for Economic and Policy Research found that the IMF programs often led to slower economic growth, some sort of debilitation, if so we speak. Maybe if you could just tell us, why is this the case? Why is this happening right now? Why is this prevailing?
In terms of the structure of the IMF, they do not necessarily drive policy for purposes of Africa's growth. They drive policy for purposes of their shareholders, the major shareholders. And in this case, of course, they are the major industrialized countries, especially in the Western capitals. So this has been a big challenge. If you recall, in the 80s, African countries were forced to privatize a lot of their public-owned enterprises. And they were selling mostly to the outsiders, which also led to cases of corruption. So there's been that challenge that IMF has a roadmap which has to fulfill the shareholder interest. But now, as it's been previously mentioned, with Africa not having a voice in this, they are unable to push for their own endgame. So I think the situation we are in now really points at, first, the need to have what I'll call financial literacy among the political leaders, because there seem to be little understanding about how the money movement or money market is working, and little understanding about the investment aspect. In Kenya, there's a joke where young people say you can hire a mzungu if you want to get money. You know, that really summarizes how IMF and World Bank works, meaning if you get somebody from their major shareholder to be part of you, then money comes to you. But if you drive it on your own, then the money cannot come to you for investment. So that's really a structural issue that needs to be changed. Otherwise, if it doesn't, then Africa will keep just being on a treadmill, each time begging, seeking for help, and nothing changes.
And maybe, James, the short-term austerity measures, how exactly does this come into play?
Well, in most cases, it's about trying to access. So, for example, we've seen in Kenya trying to get some money to make the government be able to move to its financial system to the next financial year. Mm-hmm. Then they are told, please, if you don't meet these particular requirements, then we are not going to unlock the next 100 billion that you need. So those are like bait kind of system, where you fulfill this, then we give you this. But it barely just keeps you alive. Mm-hmm. But it doesn't give you the life to be able to drive your own process. And this has been happening from independence. And I think what we are seeing now from the competition from emerging markets mm-hmm. is that countries are tired of just being kept alive. They want to actually stand up, move, and participate actively in the global trading system.
Right, Sarah, so I want to get your reaction to that. That IMF policy is not necessarily intended to drive Africa's growth, but is really for the benefit of its shareholders. I want to get your response to that first.
The IMF is not a development institution, because development institutions need to provide long-term resources that actually address sort of the social essential services. So that's the fundamental challenge. IMF programs are not long-term, they're short-term, 1 to 3 years, and they prioritize this quick macroeconomic stability over sustainable development. Now, the World Bank is more of a development institution, so I think it's worth us noting where we're getting our resources from. Now, IMF has brought about some tools because the backlash and the research has shown that these short-term austerity measures for African countries really cripple our healthcare, our education. So they've brought alternative tools to try and mitigate that development need. But at the core of it, IMF is not a development institution.
Right, so then how do you balance the need for external financing, for instance, for African countries? How do you balance that amid the risks of being unable to meet your basic obligations as government? Because this brings us back to the structural adjustment programs of the 1980s.
The question gets to the heart of this long-standing dilemma. How can African countries secure financing they need for development and economic transformation without falling into the traps? I think there are 3 main things that Africa needs to do. The first is the cost of capital. So the cost of capital for Africa is high. And we talked about this at the beginning. That risk premium, that ability for the world to see us as a risky place, it drives up how much interest rate we get on our financing. So Africa must get concessional financing. One of the data points from the One campaign is when Africa gets a loan from IBRD, which is the World Bank, it's rather than the capital market, it pays 500% less. So when it goes to the capital market, like Eurobonds, we pay 500% more in interest rates. So I think that's really important that where we get our financing, the cost of capital needs to be reduced for Africa. That's the first thing. The second thing is Africa needs to generate revenue. Enough of exporting raw materials and commodities. Because when we export raw, we don't add value and we leave value on the table. So we need to increase our revenue base. If we don't increase our revenue base, that 3% we contribute to the global economy,
right?
3% is not a lot of power. So until we increase that for ourselves, we cannot get as much voice and power in the global economy. And lastly, we also need to link our investments. When we borrow our money, we need to link it to investments that yield over time. So they need to have returns such as roads, energy, power, education, healthcare. We can find out that when you invest in these sectors, over time, you get a return for your investment. Sometimes what African countries will do with these resources is they'll get the loans and use it to pay recurring expenditures, like salaries. Salaries don't yield over time. So we have to parse out where we deploy these resources, how much these resources cost us. But very importantly, we must increase more revenue domestically.
Now, having that in mind, she's talked about conditionalities that already exist, and you did bring in, bait system, James. Maybe if you could just tell us, the IMF conditionalities usually demand measures like subsidy removal, indirect tax cuts and spending cuts. Now, Oxfam estimates 46 low and lower middle income countries, most of them in Africa, will slash annual public spending by $46 billion between 2024 and 2028. What have been the social and economic consequences of these policies within the continent?
Well, I would give a Kenyan example again. I mean, when there was that requirement way back in the year 2000, I recall many universities in Kenya got shut down because the government was saying we can no longer subsidize the university education. Then when it comes to the health sector, again, if I use the Kenyan example, you'll get that 70% of health sector in Kenya is financed by non-governmental organizations, meaning the public sector, the government has literally moved out of this very essential sector. So there's this aspect where the IMF requirements push African governments to the survival mode. And then they'll be positioning, of course, Western non-government organizations to fill in the gap. So in that case, you notice that that agency for the national government to grow private sector, to grow the necessary production capacity so that they can have a revenue sourcing level does not happen. And when you look at it from the point of view that by the year 2100, we'll be having over 4 billion people, we cannot continue with this kind of global financial architecture. Something needs to be done that then reviews how we access financing, as it's been mentioned, and then start with what we have. And what we have are minerals, for example. What we have are these regional economic blocks. So what we have are these several intra-African banks that can assist us to generate the data. Because remember, part of the risk in Africa that we are told from Western countries is that we don't know much about what's happening in there. Right. Therefore, the risk is too high. But now we have got the Afrexim Bank, the Africa Export-Import Bank, that has been doing a very good job generating data in terms of what we import, what we export. In fact, they pictured something very nice about the informal trade, which is rarely captured by Western rating agencies. There's a lot of trade, for example, within East Africa that's not formally recognized. So boosting the works of such banks to bring data to the fore so that we can de-risk our continent is very, very important.
But if you talk about IMF and World Bank policies not offering promise but risks for the continent, why do African countries then keep returning for bailout?
So at the moment, we have to realize that we are still hooked to the system. So meaning the financial sector is still very much into the Bretton Woods system. You can't just disconnect immediately. But the realities of the world right now, as we've seen, even with the increased tariffs by the United States, is that it's becoming more unpredictable. So it will be foolhardy for the African side to keep expecting that they can reform a system that was not designed for them. What we need to be looking for is Plan B. And Plan B is coming from the fact that now we can put together several African multilateral banking institutions to try craft a system for the future. Second, put together Africa mineral strategy so that at least we can use that to leverage our negotiating with the rest of the world. And of course, lastly, is to start trading amongst ourselves, because the too much focus out there means we can't produce locally. So make use of the regional economic blocks, take advantage of the continental free trade area,
right,
so that at least we can start moving goods within the continent and produce within the continent.
And we'll look at that a little bit on later in the program. But David, I want to come to you first. We've heard about the risks associated with the IMF and the World Bank policies, but are there some success stories where IMF and World Bank programs have actually stabilized economies and resulted in economic growth?
One bit that we also have to look at when we talk about financing, we have to think about the expenditure. It's financing something. So what is the expenditure? And in thinking through that, IMF, the World Bank, don't just go to these countries. These countries actually approach them. And they write very, very, elaborate proposals in their notes on, here is what we're committing to in order to unlock this level of funding. Mm-hmm. This is where we're going to spend it. And so a lot of that is usually wish list, really, so that you can just check that box and get that debt financing that you require at that time. There is never really follow through to achieve some of the things that they put in their wish list. That would be the first problem. The second problem is usually the coherence of that wish list. Because sometimes you find, like in particular cases, you've got policy rollouts that are inconsistent. You're removing an incentive here, putting one there, net effect is zero. And so that policy coherence is often missing. Mm-hmm. And you end up in scenarios where actually instead of improving your lot, you're actually worsening the situation for your lot. And so in answering that question, I wouldn't really say IMF as the actor where there's a positive result. It's actually governments. And if there's anywhere we need to really query and critique, mm-hmm. is really in government policy that is unlocking the debt that they're going for and how that impacts them. And if you look at a lot of scenarios in a lot of countries, in a lot of contexts, you'll find that often it's not a problem of revenue. It's really a problem of expenditure. What are your prioritizations as a country, and how are you spending it? And with that, therefore, you then bring in the question of governance.
Right.
How are we governing in terms of the frameworks, how are we accessing these funds, and how we are utilizing these funds?
Right. Sarah, let me rope you in here, and I want to get your view on that as well. Are there examples where IMF and World Bank policies have really assisted African countries and gotten them out of their precarious last-minute situations?
Sure. I think Ghana comes to mind. Ghana experience with the IMF in the early to mid-2000s is often cited as a relatively successful case. The country benefited from a mix of debt relief, sound economic, macroeconomic policies, and also increased social spending. I think that's really important. So what IMF brought was a fiscal discipline. It helped the country be more disciplined about how it spent its money, but it was also coupled with investments in education, health, and infrastructure. Also, as a result, Ghana's economy actually grew. There was a relatively stable growth, about 6% per year, and poverty declined. Jamaica is also not an African country, but it's also cited as one that has benefited in an era from the IMF programs. But I think there's one thing that is consistent between Ghana and Jamaica. It's strong country ownership. So as our last panelist said, countries actually go to the IMF and the World Bank to request these funds. They go when they're in dire need. So there is a lot of culpability and responsibility from the country that's receiving this. In addition to that, we see that flexibility of program design is important. A country shouldn't just receive what IMF is providing. They should be able to contribute to how it's designed because they know their people well. But lastly, we have to think about the transparency and accountability of how the funds are being spent. It's not enough that a country receives these funds, deploy these funds. If these funds are not being spent well, Africa has about $89 billion is sent out of the continent through leakages, illicit financial flows. Not just corruption from the continent, but also trade receipts from people coming into the country saying they're providing this and putting the wrong volumes and values on their shipments. So we have to curb the leakages within the continent, but we have to drive and strongly own these programs for it to be successful on the continent.
We will take a short break, and when we come back, we'll look at why calls for reform have not worked and ask whether it's time for Africa to start building real alternatives. To stay with us.
Welcome back to Talk Africa. Let's continue with our discussion. Still with us in studio, we have James Shiuati, David Owiro, Sarah Maka, and also our audience of experts and students from the University of Nairobi. Now, I'll just start with Sarah, who's joining us from Nigeria. Maybe if you could just tell us, what kind of reforms does Africa want? What are some of the progresses that we should be looking out for?
I think there are three main kinds of reforms that we're looking for. Number one is the cost of capital. I mentioned this earlier. You know, we have an opportunity this year as South Africa is leading the G20, which is a very important development. It's the first time an African country is leading the group of 20, which is the group of 20 largest economies in the world. And South African presidency has already started working on the debt issues on the continent and the high cost of capital. So Africa is looking for a lot more concessional financing, so lower the cost of borrowing money so that we don't have to pay such large debt receipts into generations to come. The second is that we need to work on trade within the continent. So again, there are things that the architecture, the global financial architecture needs to fix. But there are also things that we as Africans need to have the agency to drive. And we have to look at how do we make the continental free trade area more active and implementable. There are few protocols moving people across the continent. Many countries need to put that into activity. They need to ratify those protocols. So there's some things that Africa can do. But back on the context of the global financial architecture, there's also the methodology of defining risk actually penalizes African countries. So what we call the Basel III reform. So Basel III is what banking system and banks use to identify what you need to do to mitigate risk. So this came up in 2008 when the Lehman Brothers and the 2008 financial crashes, Lehman Brothers company went down. So they put these stringent rules so that we don't see that again. But unfortunately, those stringent rules make it so that Africa has a higher hurdle to climb to demonstrate safety. One of the rules is that if you're taking money from a risky investment or risky country, you need to put more liquidity in the bank to back up that investment. And because many African countries are deemed as risky, people will rather invest in less risky environments than in Africa, which harms us at the end of the day. So we need to relook at the Basel III framework and really change the math, the equation that defines risk. So these are some of the reforms that Africa is asking for. But I really believe that this year, being a G20 year with an African country in the lead, we have an opportunity to change some of that, those structural biases that impact Africa negatively.
So, David, I want to come to you on that question of global representation that Sarah's mentioning. And Africa now does have two seats at the G20, also has seats at the IMF board. Isn't this enough? Is this enough for global representation for the continent? Why hasn't anything changed?
What you have to think about is it representative of the voice of Africa? Does Africa have governing power, for instance? Does it have influence and agency to push through its ideas and its vision for the world? And on the impact side, you would almost ask, are we seeing from the policies that are coming out of those global institutions, does Africa have an imprint in those policies? And the answer will be maybe not so much. And that's why you see, I would say, a push by the African Union to have alternatives. So, for instance, what comes to mind here is with the credit agencies, rating agencies you have, recently the launch of an Africa-wide one that's African Union driven, to the extent that it will actually influence lenders and creditors is another question to maybe not so much, or maybe it's too early to tell. But I would say it's not yet enough. If you remember, the African Union has always, the FDB especially, has always been a member of the board of the G20, but has it translated to actually having an imprint? One would argue not so much.
Right, so James, beyond the representation issue and the agitation for reform, are there structural issues within the global financial markets, for instance, that disadvantage Africa aside from the institutions and their policies?
Yeah, the first structural point is perception. How do they look at Africa? And I think, as it has been ably mentioned, that risk factor keeps, ringing the negative bell that then makes it difficult for investments and monies to come to Africa. So I think what I foresee here is for Africa to take advantage of competing institutions. I can imagine if Kenya was relying on World Bank, maybe there'll be no standard gauge railway, So meaning that Kenya picked an alternative. And therefore, I think what Africa needs to be looking at is, first of all, who are the emerging competitors? How good or how fair are they? And how can we set the rules of the game so that then when they're competing within the African space, it ends up benefiting Africa? We know that Africa is in huge demand for infrastructure development. There's no way we are going to succeed with our continental free trade area when there are no railway lines, no highways, no bridges, no ports. The financing architecture as it is now might never really deliver those ports and highways to Africa. So Africa needs to open up in terms of who else can play in its space. And we've seen Asian countries, of course, led by China, positioning themselves strategically to be drivers of, infrastructure development. The second lowest hanging fruit would be the digital technology, because we've seen already countries experimenting on the possibility of how they can create a financing system that relies on digitalization. So, and knowing that Africa is a youthful continent, internet penetration is moving at a very high pace. I think that would be also another aspect that Africa needs to explore on how to use the digital superhighway to sort out its financing aspects. And lastly, of course, build markets. Because if we don't build our own market here in Africa, the external markets are not going to really look in our favor.
Right.
So I think we need to go beyond just proclamations, agreements, to actually building markets.
Let's just get the sentiments of Sarah on the same. Sarah, maybe if you could just talk about the global financial governance. We've seen that the structures are not necessarily in our favor, and the voting rights in the IMF are very, very skewed. Even the World Bank, when we talk about Africa accounting for about 17% of the world's population, holding less than 7% of the IMF voting rights, how exactly are these institutions supposed to change this? How are we getting the African voices?
Yeah, I mean, you're right. So there are 10 shareholders of the World Bank that actually hold 54.5% of all the voting power. So let me give you an example. It means a Belgian citizen, because effectively a country holds a shareholding power. So a Belgian citizen has 37 times more power than a Chinese, and 180 times more power than an Ethiopian. So when the Committee of Nations sits to decide, those countries have much louder voices. So one of the things on the IMF side that Africa has been pushing for is to have more voting power. And yes, we have increased the voting power of African bloc, but I don't think it's not enough. It's not enough for what we need. There is a conversation around why the World Bank exists. Does it exist for the shareholders, or does it exist to eradicate poverty and serve low and middle income countries? If that's the mission, to serve low and middle income countries, then those are the clients. So they must get feedback from their clients. They must get voice from their clients for them to be legitimate. So I think there's advocacy around the legitimacy of the World Bank and IMF, given how skewed the voting powers are. But we have to know that power is never given, it is taken. So what is Africa doing to take this power? I think it lies on our ability to increase our contribution and value to the global trade. James mentioned it earlier. We contribute 3% to the global economy. And we have assets. Africa is one of the richest continents in the world. We have assets, but our 54 countries have poorly shared and sold those assets without adding value. I think in 2025, with the tariff wars coming our way, we need to collectively, again, I use the word collectively, bargain for Africa. So until we collectively have bargaining power, that power won't translate to institutions of the world that disproportionately impact what happens to us. So it behooves Africa to have one voice when it comes to negotiating for adding value to our critical green minerals that the rest of the world needs and we have in abundance. If we don't negotiate together as one continent, then we set ourselves up for failure. So I think that's one of the critical things we need to do going forward.
Right, so we're going to take some questions from the audience. Let's start off here.
My name is Georgina Mwikali from the University of Nairobi. So my first question goes to James. So why do African countries still rely on the foreign currencies such as the USD and euros, yet they are trading among themselves?
It's a tough question, but it has a historical reason to it. Initially, the financial architecture in the older days, in the 18th century, they would back currency with gold, what they used to call the gold standard. And then that, of course, disappeared during the First World War. And then it's in 1944 that when the major powers that won when they met at the Bretton Woods nominated the dollar. They picked on the dollar because at that time the US was the factory of the world, producing all the goods that many of the countries were using during the war. And that dollar was picked on the condition that it has to be backed up by gold. And then, of course, challenges to the dollar came in the 70s, where the US abandoned the backing of its currency with the gold to what nowadays we call the petrodollar. So for Africa to effectively have its currency become a global reserve currency is a lot of work to be done, part of what we are discussing today in terms of productivity. We have the potential. We've been talking about it for over 60 years, and now the reality is hitting us that nobody really cares about us unless we care about ourselves to make sure we activate this potential, then have a bargaining power to be able to get our currencies to be part of the international reserve currencies. And that's why I said we have a tool in diplomacy, thanks to BRICS and the South-South movement. Now we have a tool because Africa is really home to strategic minerals that the rest of the industrialized countries need. So if we harness our voice and speak as one, that will give us a possibility to gain a chance in having our currencies in the international reserve system.
Let's take another question from our audience.
My name is Christian Mutunga. My question goes to David or Sarah. So while Africa is exploring options from ranging from withdrawing from these giant institutions, what are the possible implications that could arise from moves like withdrawing or forming alliances with other institutions that are regional or still international?
Let's start with you, Sarah.
So the implications of withdrawing from a global financial architecture are not insignificant, and it's one that we need to think about critically. I think the Africa Continental Free Trade Area is a step to mitigate the impacts of the global financial architecture on Africa. So what the Continental Free Trade Area is saying is we want to trade with each other. But remember, to trade with each other, we have to have something to trade. And if we have 600 million people without electricity, how do we power this trade? So there's some work that we have to do internally to be ready for that kind of withdrawal. The second thing I'll add is, to Georgina's question, we have within the Continental Free Trade Area something called the PAPS, which is the intersettlement of currency. So I can buy something as a Ghanaian from Ghana with my Ghanaian cedis. It will clear through a central clearance mechanism, and I can pay you in Kenya for that thing I bought in Kenyan shillings. I don't need dollars, because right now what you do is you carry dollars across the border, transfer it to shillings, and then pay. But what the Afri-Exim Bank is building along with the Continental Free Trade Area Secretariat is that central clearing system. And currently 15 African countries are using it. Ideally, 54 African countries start using it. So again, to withdraw, I think we need to strengthen our position, because if we don't strengthen our position, it will be like a weak member of the pack staying back, and we're susceptible to being eaten effectively by a predator. So we need to be strong for us to not just, I don't know if it's withdrawing that's required, but dictate the terms of engagement for Africa. Until we get to that place, there are not very many alternatives for us.
All right, so we're going to take final comments from our panelists here. Let me start off with you, David. As you wind up, if the current system cannot be reformed from within, is it time for Africa to look for alternatives? Very briefly with your winding up statements.
Yeah, I'd say connecting it to being tactful more than anything. We'd have to think about what is it in the current financial system pains us the most. In my mind, debt architecture is one of those. And so thinking through the kind of reforms that we require there and being strategic in going for those reforms would be more strategic for Africa.
Right, James, very briefly, your winding up comment.
Yeah, I would go for, of course, reforms of the existing, while being aware that it won't take us far, but plan B being opening up for other competing alternatives that Africa can use, because competition will then put pressure for the reform to take off. Otherwise, without competition, reform will just keep being statements for politicians.
Right. Sarah?
I'll say two things. The first is Africa must prove domestically that we can strengthen our collective economy. And the only way we do that is by one voice, speaking in one voice and acting as a collective. Secondly, we will not stop advocating and speaking for the changes in the global financial architecture. We'll use every mechanism, including the G20. We'll use our advocates, our civil society, our young people, because it's very important that the young people understand the implications of Africa being penalized by global financial architecture and use their voice. They're so creative. Use their creative voice and their digital ability to push for change globally, while putting our feet to the fire locally, that we must change for ourselves, because there's no one out there to save us. Africa must drive change internally.
And that's all we have time for on this special edition of Talk Africa, co-produced with TV47. A big thank you to our guests, James Shiuati, founder of the Interregion Economic Network, David Owiro, an advisor of Africa Development Think Tank, and Sarah Maka, Africa Executive Director for the One Campaign. Also, thank you to our audience of experts and students from the University of Nairobi.
Remember, you can be a part of this conversation through our social media platforms on Facebook and X, and you can watch this and other editions of Talk Africa on our YouTube playlist. Do join us again next week for more Talk Africa.
I'm Hibak Said from TV47.
And I'm Beatrice Marshall from CGTN. From all of us here, thank you for watching and see you next time.